One of the many benefits of being a Mott's Wealth Management client is the opportunity to meet and speak with industry specialists and professionals. Our speaker for the Forecast 2015 Past and Present event is Melissa Motts, President of Mott's Wealth Management. She has over 25 years experience in the tax and financial industry, is a CFP, CPA, and has a master's in taxation. This presentation was recorded on January 28, 2015. Hi, welcome to our event tonight. Everybody's here early, so we're going to get started so you guys can get out of here early too. So welcome to our Forecast Past and Present. I'm trying to think of how many we've done of these. It's been a long time we've been doing these now, twice a year. And it just worked out perfectly with the weather, didn't it? Yeah, we didn't lose no casualties due to weather, which is a wonderful thing. Our next event is our client conference call on May 6th, and you'll get an email about that too. It's a great way to get an update on the economic conditions that are affecting your portfolio and how we make our decisions as to how we invest your portfolio. And if you're ever interested in introducing us to someone, but they haven't been able to come to one of our events, you can let me know. We can always do just a personal lunch or dinner, something social, just very laid back and low key to meet with them. And in a few weeks, we'll be sending you an email letting you know that this recording, at least my portion of it, will be recorded and it will be on the website. So if you get that email and you want to forward it to somebody and say, hey, check this out, feel free to do that. So we'll be sending that out in a few weeks. All right, a little economic update here. The S&P 500 stock index at the end of 2014. So it's interesting when we look at this to see how the markets, if we started in 1997 in this particular graph, and it kind of looks like, wow, it goes up and down, and it goes up a little higher, then it goes down more even, actually, and now we're up even higher. So the mind could kind of look at that and put a pattern together and say, oh boy, we're due for another big pullback here, And we hear different things, about that on the news and depending on what you watch and so forth. But I want to we'll come back to this slide, but I just want to bring you to a little bit more, a longer time period. So when we look at really stretching it out over a longer time period, you can see we've had several, we call them bear markets, where we're just barely trying to get back up to where we started. And we've had several of those over time, history, and they last a long time. You look at this now, you think, oh yeah, this many years, but day by day by day, it's a long time. And then we also see these nice bull markets where they break out. The market breaks out and keeps going. We never went back down to those, those numbers. Never went back down to those numbers either. So here we are, broke out in the fourth quarter of 2013. And could it be that we're never going to see these numbers again? Very possible. Very possible. Keep that in mind. Keep that bigger picture in mind, when you're listening to the various news channels and so forth. We don't know. I don't know. We don't know what's going to happen. But we've already had a number of years where we've had big declines, bear market declines. So I'll go over today, some of the different indicators that we look at to just kind of get a feel for where we are. So coming back to the first slide, some of the ways we judge, where is the market? How's it look? How's it positioned compared with where it could be? Is it overpriced, underpriced? And one of the things that is very popular to look at is this thing called a price to equity ratio. And we can see in March of 2000, a lot of people remember that was the very top of the tech boom. Okay, that was, remember, December 31st, 1999, and electricity is going to go out, and all these things are going to happen, and none of it did, and and so a lot of companies were gearing up to get new software, get new computers, etc. And then by March, well, that petered out. They'd already done all that, and then the market started to go down, and that was a long 2.5-year process of going down just about 50%. And then we had a nice increase back up over 101%. Okay, a little higher. And then, of course, we all remember in recent memory the big decline in 2008 into 2009. That was more of a That was a much shorter and more dramatic, I would say in many ways, decline. And now we come back up, and like I said, in 2013, we surpassed it, and we've been, climbing since then. So the price to equity ratio was 25, very high in March of 2000. December, it was 16.2. The average, I believe, is about 15.7 or 15.6. We're just a little above the average. We're not that, it's not that, huge of a difference. So just keep that in mind. And the dividends. So a dividend yield, what that means is, it's like if I have $1,000 invested in a company, my dividend yield, if it's 2%, I'm getting 2% of that $1,000. I'm getting $20 a year. So back in March of 2000, when prices were high relative to the earnings of companies, we had a 1.1% dividend yield. Now we have a 1.9%. It's not, and you compare that with the savings rates, Univest is 0.05%. CD rates, I looked online today, I think it's ALI, is over 1% for a 1-year CD. But if you invest in stocks, you get a higher, this is the average yield. I mean, there are many stocks paying a higher yield than this, and you have the potential for some growth too, over the long term. And then Treasury, U.S. Treasuries were 2.2% there at the end of December. They're down around 1.8% right now, in not even a month. But a huge decline in U.S. Treasury 10-year yields. Oh, and the other thing was price of gas. So price of gasoline in March of 2000, in 2000 it averaged $1.51 per gallon. If you inflate that based on inflation since then, it's around $2 a gallon, which is a little under what we're paying right now. So it's kind of interesting, to see how things come around. And mortgage rates. Does anybody remember what mortgage rates were in 2000? No, that was back in the 80s. That was the high in the 80s. It was 8.39% back in 2000. Does anybody know what they are now? Yeah, between 3 and 4. 3, 5, and 4%. So are low interest rates good for business? What do you think? Yeah. It's awesome. Are good for borrowers? Yeah. What about savers? No. What about for the economy in general? It's good. Low interest rates are good for the economy. Keep that in mind. That's kind of the backdrop, going on, even with your new highs and all that kind of stuff. Low interest rates are good. What about low energy prices? Pretty good. Yeah, consumers make up, and we'll see that, they make up the biggest percentage of our economy, our consumers. So the U.S. buying, buying this, buying services, buying goods, etc., make the largest, group. And when energy prices go down, it's like getting a raise. Okay, let me just move forward here. Okay, so this has a lot of stuff going on. What I just want to try to bring your attention to here is that this graph over here, the S&P 500 performance and average valuation. So this is the start of kind of smaller bull markets or up markets that go up, like shorter duration ones. They might last 5, 6 years, something like that. So the gray is taking it right back up to where it kind of started, like just getting back up to where it was before. So you can see for the most part, it exceeds. The blue shows how much farther. Things don't just go back to average. Things don't just stay at average. Things go beyond average. They come below it, that kind of thing. So where we are since 2009, when we hit our last low, and we've been coming back since then, we are just about to average. We are not far extended above. So we have room to go there. So just keep that in mind too. And then here, what this graph shows, so for the S&P 500, levels near market highs. So during bull markets, which is what I think we're in, the light blue is from 2009 to today, the green for the 2002 to 2007, and the gray was from 91 to 2000. You can see like 83, 84, 78% of the time you're within 5% of the highs. You know, that's just how it works. It just goes that way. You can see you're within 1% between a third and 42% of the time. You know, so, you know, hearing these highs, these new highs, it's not a bad thing. And it makes new highs between 11 and 17% of the time. And you think about it, you know, all you need is to be 1 point higher to be a new high. And we go back to that other graph, we never looked back at these. Okay, in the 80s and 90s, never looked back. Same thing when we broke out after the Second World War, never looked back at these again. Okay, that's what happens with long-term bull markets. So just because, you know, we're up doesn't mean we've got to come back down again. That's what happens when we're in a long-term bear market. But I personally think we've broken out of that. What this graph shows, because there's a lot of talk about interest rates going up. Okay, there's been talk about that for years. Okay, years. We saw it last year. Okay, not this year. Interest rates are going down again. Okay, even though the Fed stopped buying bonds. Interest rates have been coming down. Our dollar is going like crazy. So what this shows is this 5%, there's like a magic line there. When the Treasury, US Treasury yield is at 5% and interest rates go up, the stock market goes down. That's all these gray dots in here. Okay? When the 10-year Treasury, this orange line is below 5% and interest rates go up, stocks go up. That's all this up in here. Okay? So we're down at less than 2. So if rates go up, which they will at some point, you know, we have much more likelihood to see the stock market going up. You know, and we look at that over time, there's a big difference between 1.8 and 5. So there's a lot of time for the market to, you know, continue to chug along. This is another, you know, number. We hear about these things all the time. So corporate cash, a lot of corporations have a lot of cash. Okay, a big percentage of their current assets in cash. And what we see as a result, a lot of merger and acquisition activity. They've got to do something with that money. So they're going out and buying other companies, merging with other companies. They're also buying back shares. They're also increasing their dividends, many companies. Okay, they can't just sit there on that money. It's not earning anything, right? You know, we all know. Savings rates, money market, it's not earning anything. So it generates activity, and that's a good thing. This slide I really like. This is showing, so we've got here 27 years from 1980 all the way up to 2014. And we can see returns have been positive 27 out of 35 years. Even though every year we've got losses in here. Okay, the red dots, that's how far down the market went. When you look at, this was really the long-term bull market, was from early 80s up to 2000. We only have 3 down years out of all those years. Even though, like this was up 26%, it was down 17 at one point. Okay, this was down 18, ended up down 10. This was down 17, ended up 15%. So, you know, we're going to have corrections in the year, but look at all the up years, you know, we have in there. So something to keep in mind. You know, it's okay. I mean, it doesn't feel good when you look at your account statement and you say, oh my gosh, you know, it went down a lot this month or whatever, we had this volatility. But, you know, look at what happens, you know, I mean, you know, so it shows. And then credit conditions. This is for banks. So these are for FDIC insured institutions. So banks have been raising the amount of money they're investing in stocks. You can see that. It's going up, 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 up. Foreign governments are putting more money into stocks. You know, because look, I mean, they've got to earn it. They've got to pay, you know, benefits, and they've got to run their governments and so forth, and they want to put it in something that has more growth potential in this very low interest rate environment we're in. And then, like, loan growth for banks. Look at the real estate loan. Like, it's practically zero growth, you know, for banks. Better for commercial and industrial loans. But you see other companies, like we have in many client accounts, we have alternative investments. We use Franklin Square, we use Scion. Those are just two of them where we're like the bank. We invest our money, it gets loaned out. Instead of the bank taking their big cut, we get the 7% return. So we have that. Those kind of alternatives that are available that weren't available, until really the last few years. And delinquency rates have come down quite a bit. Look at commercial and industrial loan delinquency rates, 0.8%. Companies are paying their loans. Things aren't that bad. Now we'll see what happens in the energy space. We've got a couple slides on that because we've got had so much decline in the price of oil. It definitely affects those companies. And then the labor market. Look at the slide over on the right. That's the labor force participation rate. So that's how many people as a percentage of all the labor force are actually working. And you see how that just keeps declining? And then it's slowed down. It hasn't, it's kind of stayed about even now. That could have to do with unemployment. They stopped extending those benefits, so people are going out and getting the jobs now, instead of continuing to collect for a long time. It also, just the baby boomers retiring, big effect. There are less people. And unless, and this is a politically hot topic, but with immigration, policy and so forth, if we don't grow our workers, you saw Social Security, less and less people are contributing in for all the people taking out. And the labor force participation rate, will probably keep declining. So there are benefits to having a friendly immigration policy. And this slide I always find very interesting, the level of income with whether you have high school, less than high school, college or greater. So it's still better to have a degree. And even an advanced degree, you'll make more money. But the one thing I find interesting is how close it gets between some college and high school. The sad thing there is, if someone has some college and they have debt and they don't have a degree and they can't get the job and get the pay, but they've got to pay the debt. That's a tough situation. But it still makes more sense to have a degree. And then these are the inflation numbers. And they're low compared to what the government wants to see them, where the government wants to see them. But we can see what the 12-month change was here. So food and beverage was up, housing was up slightly, clothing was down a little bit, recreation went down, education went down. And of course, energy was lower overall. Speaking of energy, what this shows is the production versus consumption. So if you look at the US, our consumption went from 19 million barrels a day, stayed the same. They're expecting it to go up slightly next year. But look at the increase in production. Literally, it took 20 years for production to decline, and then 6 years for us to make that up, to go back to where we were 20 years. It's like 28 years, 26 years ago. We're back at that level of production now. And because so much has been going on and drilling and all the various ways they have of extracting energy now, they can turn it on. They can turn it off. They're burning up gas. It's not even being used. It's just being burned up. And we have so much. And when we look at the total global consumption, we can see it's going up slightly. Look at Europe. That's going down every year. The demographics in Europe, down, down, down. They don't have as many children. Look at Japan, same thing, going down. You see China going up, and other, that's going up, but not enough to make up for the increase. We're talking really big increases in production there. And I like this one, the price of oil. Has it been 45 this week? It was 57 at the end of the year. That's a big change in less than a month. I don't think it'll stay down there. I think it will go back up to a more, kind of reasonable number, but I'm really enjoying filling up my tank right now. With my 40 cents off from Hennings, I paid under $2 a gallon. I don't know. It's just something about that I feel really good about. The last slide I have here are the energy price impacts. So, of course, we know, where gas prices are right now. And percent of income spent on gas and motor oil. I mean, look at it. For the lowest fifth of the citizens in our country, it's over 12% of their income. I mean, that's big. So when they get the savings like that, seeing the big price drop, boy, they can, they've got the money to now do other things, and that's a boom. We saw the consumer confidence numbers are just really big, came out in January. Big, huge increase because of that. And we can see which countries we feel so bad for, like Russia, they're an exporter. So they're hurting. But we're still a net importer, the US. We don't make enough, we still import oil. So, it's a benefit to us when the price is down. Yeah, so in general, things are good. Low energy prices, low interest, breakout of the stock market indices. I'm very positive about the future. And and I can leave it at that. Well, thank you so much for coming. Enjoy your evening. I hope you enjoyed listening to Melissa Motz. And if you have a friend or relative who is considering their financial options, please feel free to invite them to accompany you to one of our upcoming events. Visit our website at www.motz, that's M-O-T-Z, wealthmanagement.com for the most up-to-date listing of these events. Over the years, many of my clients have asked me to speak with a friend, relative, or colleague concerning private financial management. I consider it an honor and a privilege, and have been happy to accommodate those wishes. For your future reference, I want you to be aware of the standards by which I comply with such requests. First, confidentiality is the cornerstone of my business. Each of my client relationships is distinctly separate and totally private. Second, thoughtful and courteous service is guaranteed. This is a people business. Finally, I will never give advice and counsel to a client without thoroughly understanding his or her needs. Please contact us at 215-513-6240 or send me an email at melissa@motzwealthmanagement.com. Melissa H. Motz is a registered representative, securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Melissa H. Motz is an investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Motz Wealth Management and Cambridge are not affiliated.